We are covering all of the amazing things that involve risk transfer or basically insurance, and we're going to be real specific to work comp. So I know there's a lot of questions on this, and this kind of started with our first segment 2 weeks ago. So as I talk through this, I want you guys to stop and ask questions along the way. Do know that there will be a little handout that I send out afterwards, just kind of as like a cheat sheet in case you ever need help with this, because there's a lot of different players in the game. And I want to make sure that you have cheat sheets and that it is fresh and there are different ways that we can go about this. So with that, welcome to our continuation of For the Love of Workers' Comp. And today we're going to talk about risk transfer, or basically insurance. So there are a lovely amount of different ways that people can transfer risk. So workers' compensation was created to actually help employers so that when people were injured, they weren't paying dollar for dollar, or that injured workers weren't suing the employer for everything under the sun back in the day. So this is started in the early 1900s, where there's the actual history of workers' compensation, and then each state started to adapt it. And by 1942, all 50 states had adopted workers' compensation insurance. So with that, not every employer has very specific workers' compensation insurance. So we're going to run through these programs, and I will hopefully give you guys a better illustration of what exists so you can understand who's important and who's not with your specific clients. So with that, the purpose of today's training is to just give you guys a better overall view of how people choose to transfer their risk and why would you do insurance versus a captive. Why do brokers get involved? And we will get into the nitty-gritty of this so that you guys have a better understanding of how this landscape came about and why people choose what they do. So I want you guys to understand the fundamentals of risk, explore the mechanisms that exist within this place, also the different tools that are available, and we will look specifically at insurance versus TPA. And then also one other one that I really want to make sure we spend time on is the broker relationship. And then what's the impact of having these type of programs? Why one versus the other? Again, ask questions. There are no stupid questions. I promise. This is such a very, it's not an easy space. We'll say that. So I'm going to do my best, and you guys stop me and let me know what you need along the way. So with that, what is risk financing? Let's start this out. So I want to give you guys like an overview of why this stuff is even available and what we would do with that. So when we start looking at risk financing, it's really like the ability to get funds and to help offset any of an organization's losses. So there's a plethora of ways that we can do that. Sometimes the companies will have enough cash flow or assets or credit line. Other times they don't. So we have to look at different mechanisms for how people are going to pay. This can be a pre-loss financing, or it can be post-loss financing, and the company can choose how they structure this. Again, it's very easy in the risk management space to be able to figure out, all right, here's what we have. How do we take money and make it work for us to be better? So when we start looking at this, risk basically is cost. When we look at risk management, it's basically cost management. We make all these very fancy terms for things, but we're looking at cost management. So loss costs and the cost of uncertainty. So when we start looking at risk financing, we're looking at measures and methods that come to fruition when we start to look at financing our cost of risk. It's basically paying losses. So somebody's going to get injured. We got to figure out a way to pay for it. But a lot of financing arrangements, think about your own personal health insurance, and I don't know what that calls this, so I'm not meaning that to slam or promote either, or just saying like you've got a plethora of plans that you can usually choose from, and how you are going to finance your own personal risk. Maybe you never go to the doctor, or you're like me who breaks bones really randomly. So you want to look at how much do you want to gamble on the risk that is associated with your organization, or for the personal aspect for your life and your families. So insurance itself is an example of uncertainty, and premiums are paid when we're looking at insurance, regardless of if there is a loss. So when we look at risk financing, it can include losses, it can include premiums, it can include safety programs, claim software, research, any type of consulting that might need to occur, and even a risk manager's salary. So all of that goes into this financing. And risk gets divided into two categories, insurance and not insurance. So when we start looking at how this happens and why it happens, there are some things to think about. So when we look at this, we want to look at what kind of retention are we willing to keep as an employer? Do we self-finance where the company will bear the greater cost? Or do we start looking at the transfer process and look at risk transfer and transfer the responsibility onto someone else? So when we look at risk retention, again, this is that self-financing component, looking at paying for losses through the organization, looking at cash flow, looking at saved funds, maybe bank lines of credit, contributions from stockholders, probably not something that you really want to do, but know that it's available. And then when we look at the transfer component, this is where we transfer that responsibility to somebody else. And that's where we start to look at insurance or a form of insurance, which we'll cover a couple of those. The economic impact is transferred, not the actual risk itself. The risk stays with the employer, but the economic value then moves over to an insurance company or an insurance product. And this is done for a lot of reasons. Sometimes people just don't have the capital. Some people aren't liquid enough, but they make payments either for a policy for a year, or they might make payments over a period of time. It depends how much risk they want to take on themselves. So we can look at risk financing in a couple of different ways, but a lot of times people are going to try and share the risk so that they are not held fully responsible. So if you think about deductible programs, or if you're going to go see the doctor and it's a $50 copay, this is where we start to look at how we share risk. So we've just talked about risk retention and risk transfer. The resources that come into looking at these risk sharing is where we start to look at a couple of different areas along the insurance space. So we first need to look at what resources are available. Do we have company cash flow? Do we have assets? Have we borrowed? And what do our stockholders say? Now, if we're not going to keep it on that level, if we're going to start to transfer and share in some of that risks, do we want to look at insurance? Do we want to look at not insurance, or do we want individual investors? We don't want individual investors. And then will any of our losses destabilize our net worth or our cash flow? Those are things we've got to consider. And does an outside organization receive money for accepting our risk of loss? So for a risk transfer, that's where we're looking at insurance premiums and or compensation to a non-insurance organization. So let's get to talking about some of those so we can get a little bit more clarity on this. So self-insurance, this is where you're going to see the TPAs get involved. Self-insured programs. This is where an employer retains all of the risk for their loss costs of their losses. So when we look at this, it might look a couple of different ways. The company is going to pay for everything that is associated with their claims. They keep internal records for their losses, and they will make a formal system to pay for them. That might be within their organization, or they will hire a third-party administrator to handle their claims for them. Now, it depends what kind of claims that people have for what they will do with this. Some organizations, I'm going to give an example of Walmart, have their own TPA within their walls. And so it's technically retained as self-insurance, administered by themselves. And that's going to be like a very good example of somebody that's self-insured, that's going to retain their risk, and they pay their own claims. Kind of fascinating. And companies that are big and have that ability for cash flow, great for them. The other things to think about is what is the frequency and severity? So if there are a lot of claims, does an organization who is self-insured, who's going to handle this internally, what kind of volume is that going to be? Is that enough to just have one person? Do you need 10 people? What does that look like? What's the time consumption? And is the organization able to kind of have that kind of structure for that? And it totally depends. Something else to consider along this, when we look at claims handling. So again, it might be an employee within that organization, or it might be outsourced to a third-party administrator, that TPA. And we're going to talk about TPAs a little bit more in depth here shortly. But sometimes there has to be a claims handling protocol in place, and some employers do not want to have to deal with that. So people can obtain the third-party administrator. And with that, some states also require you to have a third party administer your claims. So again, we have 50 states. Everybody's got their own rules. Some will not let a company handle their own risk. So some things to think about. So when we look at a TPA, and I know this is a big one for us to cover. So this is where we have a third party that is not owned or operated by our company handle the risk. So they become under contract to handle claims either on behalf of an insurance company or on behalf of a self-insured employer. This is where it gets tricky, because insurance companies can write paper to insure an organization and still not handle their claims. The paper can be written under an insurance company, and then you can still have a TPA like Sedgwick actually handle the claims under a contract. So this is where this gets kind of murky when we start looking at, okay, so who's responsible for what? But the third party administrator, this is where you're looking at your Sedgwicks, your Gallagher Bassett's, CCMSI, Broadspire. There's a lot of them out there. There's a lot of boutique as well. But these are organizations that are under contract to administer claims independently of that organization. And again, sometimes they have to be, it's a state requirement. So it's not up to the employer to decide whether they want to keep the risk internally or if they want to have a TPA handle them. It might be state specific. So with that, why would somebody choose to self-insure? So again, this is keeping all of the risk within themselves. So when we look at, there might be some cost savings. It can be immediate from a cash flow standpoint. There's less expenses for insurance margins if you're self-insured and you're not paying somebody else to be able to hold your own risk. So again, if companies are really large, this might be something that's smarter for them to do. If they have solid risk management programs, this might be something that's incurred for them. They also don't have to pay another company's profit margin. So there's no insurance company overhead that they have to worry about. From a cash flow standpoint, loss payments can be spread over 2, 3, 5, 10 years. And then you can look at the investments with the gains that are realized as a result of that. You can have customized programs because it's your money. So then you can develop and pick the vendor partnerships that you want, and you get to be fully responsible for who is going to be a part of your program, again, because it's your money. It can improve safety because the employer is much more aware of what the losses are, where they're coming from, what kind of loss control measures need to be put in place, because again, this is the organization's money. So they're very conscious about that. Sometimes they can increase employee satisfaction by means that employees' claims are handled personally. So if they're handled within the organization, there's much more "you are people, we're one company, one team," or they're handled by a dedicated team on a TPA. So there is familiarity with that organization and that program. There's also a better coordination of benefits. And that's where you're looking at, it's not just work comp, but maybe there is a need for long-term disability or possibly FMLA. So those are things that you want to think about. And then some of the disadvantages of to being self-insured, and again, having either the claims handled internally or utilizing a TPA. There is an increase in administration cost. So there are more state requirements to be able to be self-insured. States do require formal documentation to be able to support that you are self-insured from a workers' compensation standpoint. They must submit loss data, and you have to submit your financials annually. And then there is the oversight of vendors, making sure that they understand they're operating as an extension of your program, which makes it important if you are white labeling something or even being a representative of that organization. Employees who become injured do not care if it's a Sedgwick or a One Call Medical or whatnot. It is still seen as the employer because I've been injured. I need to make sure that I'm getting the care that I deserve, and this is a claim against my employer. So anything that's affiliated with that employer, the third party administrator, whoever, maybe if the claim is handled internally, and any partnerships that come about that, all are an extension of the employer. There might be a spike in losses, meaning that there's something that's catastrophic that occurs. And so then you'd have a large aggregate of losses at once. So that would be a disadvantage. And then the state requirements. This is where states are looking for bonds, letters of credit, cash in bank, financial ability to pay claims. They are looking to make sure that if something happens to your people, you are able to pay and take care and restore the livelihood of those people. And that money is available not only for your work comp losses, but also is there still money for investments? Do you have money for payroll, research, et cetera? And if you're tying it up in lines of credit that are proving that you can support yourself from a work comp standpoint, that might be a disadvantage for other investments that you would want to make along the way. You also have to have certificates of insurance that are contractual requirements to provide or to produce insurance. Self-insurance can be questioned versus regular insurance coverage, where you can just produce a document that says, yep, this company is insuring me, I'm good to go. Excess coverage, I'll talk about this too. This can have variable pricing if you are self-insured, and companies might have to assume more risk along the way, and I'll show you a specific example of that. Other insurance coverages might be more expensive as a result of this. So if you only self-insure your workers' compensation program, it might not be as a competitive market to go get multiple lines of insurance like business operating insurance or anything else from property or you name it. Like a lot of times they'll bundle these into like what people call a BOP or a business owner's policy or things like that. And they can be a bundled programming. Think from a personal standpoint, if you bundle your auto and home insurance, things like that. And then also tax implications. There's a couple of these that have some lovely tax components that arrive in it. So you might not be able to deduct your loss reserves where certain risk transfer programs you can. So you're only able to deduct paid losses, even though you might have money set aside for funds to be able to pay for medical treatment for someone for the next year or two. Insurance premiums can be deducted from taxes. All right, so then so that was self-insured. Now let's talk about insurance. So insurance is a contract between two parties. So we have the insured, so in our case for workers' compensation, the employer, and then it is in a contract with the insurance company or the second party. There is a premium that is paid, and in exchange for that premium or that amount, the insurance company agrees to pay specific claims. So if you think about this from a personal health insurance, you know what? We have a premium that is paid annually. Maybe some of it is offset by your employer. And in exchange for that premium, we are then covered. So same thing happens for workers' compensation. Now, insurance is based on the law of large numbers, meaning we're going to take premium in from all of these people and hope that most of them don't end up getting injured, because that's again how insurance companies stay sustainable. There we go. Say that 10 times fast. So the insurance company then takes the premiums that people pay. So whether it be the organization or from a personal health insurance standpoint, our premiums from a health insurance, and they put them in a reserve fund. And then the losses are then paid from that reserve fund. State agencies then monitor the insurance companies. So you have a Department of Insurance that oversees from a compliance standpoint. The Department of Labor will also pay attention to this from a work comp standpoint. We have the workers' compensation division, so very specific into injuries that occur on the or at the workplace. And then there is also sometimes an industrial commission. So when we're looking at the funds that are overseen in these programs, they're pooled together for the loss exposures of their insureds, expecting that the total number of premiums, collected plus the investment income that they're going to get from this will be greater than the injuries or those losses that come in, plus the expenses affiliated with them. And then they should still have some reserve funds to make sure that they protect their assets. So again, we've got people paying their premiums, we put them all in a bank account, we invest in that money, and we pay out the losses plus the expenses from that, hoping that because of the law of large numbers, that we're going to make it out on top. Now, the Department of Insurance, and when we start to look down into who is overseeing these programs, this is where they start to look at what are those reserve funds in case there's a lot of losses. So insurance companies always protect their company's strength and revenue when they choose who they're going to insure. So that's the other thing. Just because you want to go buy work comp insurance, there's a lot of things that go into it on which company will insure you and what costs you're going to pay for the premiums to have the insurance company assume the risk. So there are a couple of different options of insurance companies that exist. So a stock insurance company means that it is owned by stockholders. So stocks you can go buy on the insurance exchange. Actually, W.R. Berkley's is a great one. If anyone pays attention to the stock market, it's wonderful. Most property and casualty lines or multi-lines of insurance companies that have auto, property, general liability, workers' comp, if they have multiple lines of insurance, they are more than likely a stock company. Other examples of this might be AIG, Zurich, Metropolitan Life. All of those guys are stock insurance companies. Another type of insurance company is a mutual insurance company. And this kind of a company is owned by its policy holders. So stock is not available for purchase, but a majority of life insurance companies are mutual insurance companies. If you think of Prudential, for example, that is an example of an insurance company, Farm Bureau is an example of a mutual insurance company. And so when there is excess, instead of paying dividends back to the stockholder, policyholders can then reap the benefit of that. Prudential is an example of an insurance company that was owned by its policyholders, but then decided to change and became a stock insurance company. Lastly, this one is not nearly as common and probably one that you're not going to deal with. However, I don't want to be amiss and not cover it. A reciprocal insurance company or a reciprocal exchange. Unincorporated association with each insured insuring the other insureds within the association. So people insure one another in this little pool. So the participants in the pool are both an insured and an insurer for this. And an attorney, in fact, administers the exchange on how paying losses experienced by the exchange help invest that premium inflow, recruit new members, you name it. I have never come into contact with this in my 20 years that I've been in the insurance space. Not saying that we won't, but it is not one that is kind of high on the list. Usually you're going to see insurance companies that are owned by the stockholders, or you're going to see mutual insurance companies that are owned by policyholders. So things to think with that. So when we start going into insurance, we have a couple of different kinds of insurance. So when we look at how do I want to insure my workers' compensation program, I'm going to purchase insurance and transfer the risk by giving premiums to an insurance company. There's a couple of different ways to do that. And this is where we look at guaranteed cost, retrospectively rated, large deductible, like those are the different types of programs. And then there's other insurance that we would want to consider. Maybe we need excess insurance, which would be more than just your standard workers' comp policy, an umbrella policy. I have a 15-year-old daughter, and I know that she's going to be licensed here soon, and I needed a personal umbrella policy for myself just in case something would happen. Knock on wood, I hope not. Companies sometimes need reinsurance. And then we're going to look at specifically what is the difference between a captive and a risk pool. And we just went through the actual insurance companies right there. So let me start to look at this a little more in depth. Guaranteed cost means you are a fixed cost. When I get a policy from an insurance company, they will pay for all of my coverages or any claims that occur for the year for that price. So whatever that was. So let's say I give you $100 and I have 100 claims. Well, I don't have to pay more than that because it's a guaranteed cost program, no matter how bad the claims get. This means you lose pretty much all control of how you want the program structured. So when we looked at self-insured, we talked about how self-insured, you get all of this control because it's your money. So you can pick what providers that you want to use, like from a vendor standpoint. You can really dictate how people are going to communicate with your injured employees, and there's a lot of control over that. In an insurance program that is guaranteed cost, you kind of lose a lot of that because the insurance company has taken this on now, and they get to assume the risk and handle it how they want because it is now theirs. So that can be a bigger difference than something like a large deductible. When we look at large deductibles, we're looking at large deductibles, meaning like $350,000. So the employer or the organization will retain that risk, and they pay dollar for dollar up to a specific threshold. So think about that back to your insurance premium. Think of like a copay, except that we are looking at it in a much higher standpoint of like $100,000 or $250,000, $350,000. Sometimes with that, you still will use a TPA to administer that, and then it just kicks into the self-insured layer, and there's large deductibles, self-insureds, they all kind of start to get a little convoluted, but it ends up being whose ownership is where and how much control do they have during that time. Retrospectively rated is where if you are paying a guaranteed cost program and you blow it out of the water, sometimes there will be a clause that says the company can come back and do an audit, and sometimes they will ask you for more premium as a result. This is where when we look at fraud in workers' compensation, this is the big one. Employers tend to be higher on this. A lot of people say, it's injured workers. No, statistically speaking, injured workers make up 1% to 2% of the fraud in workers' compensation. Employers make up the bigger landscape of it, and then medical providers. But a lot of times employers will lie about their payroll, how much it is, and what those people are doing. So there are classification codes that help insurance companies price out the risk of insuring that program. So if you have drivers versus non-drivers, or you have clerical staff versus roofers, there's going to be different class codes that are affiliated with specific loss costs. And this is where if we are going through programs and we're paying out quite a bit of money to insure in a specific entity, this is where underwriting will come back and say, we're going to come back and retroactively adjust your policy. So some companies will allow that. Others, you might pay more to not have them do that. It's a little interesting on how that works. Large deductible, we just talked about where that is very kind of like paying your copays. So you've got that first set of money that you're going to need to pay and where you can have some control over. And then once we hit over $250,000, $300,000, then it will bounce into a different type of policy. Then when we look at excess insurance goes above and beyond kind of what a normal policy might encompass. And again, these are very specific where it might be a per occurrence base or a per claim base. So per claim means any claim that is filed one after another. An occurrence might mean there were 7 people injured at one event. Maybe something blew up and there were 7 injuries as a result. You will still have 7 different claims, but if it is combined, excess might take over after those combined claims hit that $350,000 mark. And so that can help transfer risk in that standpoint. This helps protect against specific financial losses. And again, we're talking about hundreds of thousands of dollars at this point. And it might be specific versus aggregate because everything has to have multiple specificity within this. Specific excess means that it is a single high dollar loss. So that would be per claim. And then when we look at aggregate, that is when we look at per occurrence. And that would be if you have that horrible catastrophic incident where there are 7 people who get injured and we're only going to have to pay the first 10 million out of 20, or maybe it wasn't that bad and we're down in like the hundreds, but the aggregate ends up helping people protect over those bigger catastrophic losses. We see this a lot more in higher hazard programs. I know Berkeley Industrial Comp has a high hazard program because these are really expensive losses. And so we want to figure out what layers that we need to insure so that you're not paying it out of that dollar for dollar area, which can be kind of gnarly depending on what is happening. Okay. The next program that I want to cover are called captives. These are hands down my favorite way to insure because you are dollar for dollar up to a specific threshold for a group of employers. So I think these are just great. You have good control over your losses. It's a great way to make money. So a captive is called a captive insurance company, and they are similar to an insurance company that they insure the risks of businesses that share a common ownership. And so the owner of a group of businesses can form a captive. So I've been a part of a captive before where we all were of the same like structure. We were all from the same geographic location and we all operated in similar businesses. So captives can be very specific into who they will allow to be a part of this little insurance pool. The owner of the group of business can be a wholly owned captive insurance company, and they are called captive insurance companies, but for all greater purposes, we just call them captives. But they are trying to insure related companies. So you end up assuming the risk of the other organizations that you are in a partnership with, but you as the business owner get to choose who those people are. So you might have 10 different organizations that participate in this one insurance captive program, or I've spoken at insurance programs where there's 2,000 captive members. So it depends what kind of group it is. They can be very small, they can be very big. They are formed to save insurance premium costs by investing the premiums. So where an insurance company will take it and they do their own investment, this ends up being done, and the shared group resources then go back to those insurance companies. But it means that company A is going to absolutely be okay with bringing company B in, and company C and company D. And if I'm going to have a loss from company A, companies, D, B, and C are totally okay with that. This is where you have to have that assumption and that open communication of, okay, here is the nature of our business. This is what our loss control programs look like. Here's what our claim losses look like. Are you okay coming into this and buying into our risk as well? The premiums and there are cashback profits that help with forming these groups. Kind of similarly to the self-insured, you have to be able to prove that you have the cash assets to be able to be part of this group. And a lot of times you have to pony up a specific amount of collateral to put into the captive to even become a part of it. A lot of times you cannot get that investment income back for at least 3 years. So if you're going to pay to be a part of a captive, you have to actually put down some collateral. And I think when I was doing this, I worked for a company that had about $30 million in business. And I think we had to put $650,000 in to just start to even do the paperwork to become part of a captive. Now, captives satisfy the need for companies in high risk industries where a lot of normal insurance companies might charge them ridiculous fees and expenses. So some companies can assume some more of this risk where if you know there's a few of you that are operating in these high risk industries, instead of paying an insurance company to do this, these guys understand they pool their risk together and it can actually be less expensive than sending it off to an insurance company. They can save on expenses, they save on premiums. There's a lot of flexibility from the financial perspective, and there are a lot of tax benefits that come into play with this. The different types of captives that exist, there's single parent, which it means an insurance or a reinsurance company formed this to insure the risks of its non-insurance major company who owns it. So it's going to be like a side hustle for them. An association captive is one that is owned by a trade or an industry or a service group for the benefit of its members. So think over the road trucking. I know that there is a captive that very heavily supports that. You could have refrigeration groups. There's just little different entities that might cleaning organizations like industrial cleaning might have their own captive. Staffing agencies have some of their own captives. So staffing agencies for high frequency, maybe they're more like clerical staffing agencies, they might have their own captive, or industrial staffing agencies, because that's a very high risk, high hazard. They might pull their resources together to have that. Group captives are jointly owned by a number of regular companies, and they're just providing a vehicle for people who want to have their own investments. And again, this might be done from a group's captive standpoint for people that just know that they have a good risk program. They don't have a lot of losses. They have to be able to prove that they have insurance, but they've got a good enough control over it that any money that they're paying out, they know they're going to see their investment return. So instead of giving the insurance companies money to profit off of, they get to keep it. And so one of the highest reasons that people go into a captive is because if I give you $100 and let's say we only spend $10 of it, the insurance company normally gets to keep that 90 and reinvest it. In a captive, it ends up coming back to those partners. And again, it usually takes about 3 years to be able to start seeing these returns. But if you have a group of people and you're all pooling in those premiums that you would normally be giving to an insurance company, you can make some really good money if you are smart in your safety programs, you're trying to mitigate all of your risks, and you get some really nice tax incentives by it. So there's, again, if you've got good control over your programs, captives are a great way to increase your financial structure. Agency captives are owned by insurance agencies and brokerage firms. So this is where we get a little bit complicated again with our multiple people here, because they reinsure part of the portion of the client risks through their own insurance company. So this is them just having some oversight over it and having some type of financial backing to help incentivize these guys to have strong risk programs and be very mindful of what type of safety protocol that they have, what type of training and education is going into their employee base, et cetera. Then the last one that you don't see as often is called rent-a-captive, and this provides captive facilities to others for a fee. And this is for companies that are just too small to buy in. They just don't have enough collateral. They're just really small organizations. Excuse me, not that they don't have money in capital, that would be a risk pool. They're just too small to justify establishing their own captive. Usually you need about $1 million for justification of buying into a capital. So what that would mean is your workers' compensation, your property, or excuse me, they don't insure, captives won't do property because it's too volatile. But you've got your general liability, your auto, and your work comp, because those can be severely impacted by loss control programs and proper risk management tools. So about $1 million, if you're going to pay that in premium to an insurance company, that's where you want to start looking at, is this the best way for us to be investing our resources, or should we think about risk pools? Are very similar to captive structure but these are really small. They're groups of small businesses or nonprofit organizations that have to pool themselves together to be able to transfer some of that risk. Each member pays a premium in, and it operates as an insurance company, very similar to captives. But these guys have to band together because individually they would not be able to purchase insurance by themselves. So this is when we start looking at nonprofits, just again, kind of similar to the captive structure, but these guys don't have that $1 million, and they need to be able to pool together with my 3 employees, maybe with those 2 employees and those 6 employees. Together, we can buy a policy that covers all of us. Each insured member of the pool will contribute premium for their loss exposures, and in exchange, the pool will pay for the covered losses. So again, very similar to captive, just again at a much smaller scale. It's governed by its members. It can also be considered a stock insurance company for risk pools and or a nonprofit unincorporated association. They collect premiums, they pay losses, and they purchase claims handling resources, and might provide other things like risk control, loss control, risk management programs, things like that. They are technically a group or association captives. They're just more pooled together. Again, think smaller scale. So you're not going into a risk pool to make money off of your insurance. You're going into a risk pool to be able to have coverage. So little difference in why. We do excess insurance again when we're going above and beyond. So we've purchased a policy. Policies will go up to a certain threshold, and this is where we want to start transferring that risk. We talked about specific and aggregate. You might also have a self-insured retention where we're going to pay dollar for dollar. It operates very similar to a large deductible plan. So again, think 250,000, 350,000, maybe $500,000 that we will control. And then anything in excess of that will get turned over to the excess. You guys will probably not ever see that here at MedCall unless it is like a ridiculously horrific loss on the get-go where we know we're already at $500,000 because of the severity of the injury that transpired. Things to think about. So when we start looking at the different layers, so self-insured, let's say self-insured responsibility, this could also be similar to a large deductible. It depends how the plan is written. And remember, who's actually responsible for the decisions that are being made. So this would be more of like a client responsibility or an employer responsibility. And then let's say anything over $1 million, $1 million to $5 million will be covered by excess. And then maybe we need more than that. So then we would have an umbrella policy that's for anything over $5 million. And then when we look at aggregate excess, 20,000 to 20,000, 20 million plus for a policy limit. Berkeley is incredibly good at these multiple layers for risk transfer. If you ever get to see how they have structured different organizations, it is phenomenally fascinating on the different layers of approaches once we're getting into those higher dollar amounts so that they aren't having to pay cash out for it. So things to think about. Also, not to confuse you guys, but there's a lot of other alternatives that exist, and I just want to touch over them. There are specific terms for railroads. Federal Postal Service has their own work comp acts. We've got maritime. We have energy for nuclear workers. Foreign U.S. military has their own. And of course, each state has their own work comp statutes that we get to follow per state. So fun. So there are at the federal level, there are other alternatives outside of what we've just talked about. And then there are also state rates that exist with specific laws for each organization within the operating 50 states. So to look at the risk transfer versus risk retention, that transfer process starts where if you do not want to have any, we're just going to buy a policy and transfer it over. That's where we start at guaranteed cost, all the way up through we're going to retain our risk, where we look at that self-insurance. And then this is kind of how you start to see, do we want to transfer some of our risk or do we want to transfer 75-25? And you start to look at the different financing plans that are available depending on the size of your organization, and if you want to use this as an investment opportunity, or if you literally just need insurance to be able to operate your organization. All right, insurance brokers. So what are these guys? Okay, these guys have about five roles that they tend to play in this space. They operate as advisors for employers. They help navigate what's going on for insurance solutions. They will negotiate the terms for the policies that exist with insurance companies. They also try to help streamline the claims process to show that they can add value. And they also offer continuous support and education. They are not part of an insurance company. They are not part of a TPA, but they are the side person that likes to come in and add value. And as a result, they get some commission as a result of selling policies kind of on behalf of specific insurance companies. The goal for them as advisors is that they are trying to offer unbiased opinions. A lot of them have affiliates of who they prefer to work with. They do try to identify workplace risks and tailor specifically to an organization's needs. Not every organization or employer has a broker. Sometimes it can be larger companies, and other times this is where you start to look at, what do you do for yourself personally? Do you go online and buy a policy, or do you have a personal insurance advisor or an insurance agent? Very similar. This is just done at an organizational level. They try to help you guide through what's the best way based upon your organization's financial structure. What should you do? Very similar to like an insurance agent for you as a person. Like, again, I probably need to go talk to mine and be like, what do I do with my child? And they're going to tell me to go get an umbrella policy and all this other insurance to cover everything that could possibly happen. Again, risk transfer. What are you comfortable keeping? What do you need to transfer to either a policy, a captive, you name it? They will help negotiate terms. And then if something goes wrong on the claim side, sometimes the broker will step in. If it's on the insurance company side, you'll see this a little bit heavier than if it is on the TPA side. And then lastly, they do try to keep an education stream flowing, because again, if the employer or the organization that they represent can have like a great loss ratio or not have a lot of claims, it makes them a more viable target for specific insurance companies, and that can increase revenue to the broker for bringing them the business. So thought I would stop there. A lot of stuff for you guys for today. I will make sure that you get a little handout that highlights all of this, and then a nice little summary article. So where there's different mediums for you guys to learn. Is there any questions off the top of your head today?
I had a question about how many states don't require a TPA? Is there just a few of them?
Yeah, it's not as many as it used to be. I will double check on the states that require it and send you a list of these states require self-insureds to have a TPA and these states do not.
Okay, thank you.
Got it. It's a lot more complicated than it should be.
Yeah.
But if you can relate it to like your personal stuff and you think about, all right, if I need my own insurance, which I don't know if anyone saw this, but New York Times published something last week that the greatest people in debt to medical care facilities right now are those with insurance. The United States is an interesting place.
This is David here. I got a quick question.
Yep.
Since you mentioned that, worker comp got so many different levels, right? At a state, at a federal, and even the federal in the industry.
Correct.
How does that impact our business, right? Because right now, yeah.
State always state first.
Okay.
State will trump everything. So this is where, to Bill's point, like, can we have a breakdown of what states want this and what states want this? Yes, that is where you're going to reside, because for any individual, unless you are a federal employee, so let's say United States Postal Service, you name it, especially since yesterday was President's Day and they did not deliver mail. If you're going to try and file any type of action, legal action, or any type of state forms, they are going to go directly to the state and not to the U.S. government. They're operated very specifically. Workforce development and the Department of Labor are also specific to the state.
Okay, all right. I just want to see if there's any impact, like, because I know now it's working on the hierarchy. So if we have something in a federal, but you're saying
Yeah.
everything is going by the state. Okay. Thanks.
Great content, a lot to digest. So,
It is. That's why I'm
Yeah.
we'll write a couple of,
Thank you.
I'll try to do a couple summary articles for you guys that you can read them in a week or two, and then also make you a cheat sheet with, okay, wait, this is a company, or this is a captive, or this is this, and we'll go through that. So you guys just have that as a reference point for you.
that's great. Thank you.
Great, Thank
Really
you.
appreciate it.
You Got it.
Great.
Claire,
Okay.
specifically for Berkeley, sorry, this is Ian, by the way.
Yeah.
Just for Berkeley, do they write all these types of policies that you've gone over? I guess except maybe captives,
So
because
Berkeley's really smart in how they do that. So Berkeley, for their own employees, just so you guys know, they outsource it to CNA. So they buy a policy from CNA at a guaranteed cost because they don't want to deal with it.
okay.
Kind of interesting. But Berkeley they don't use their own money to insure themselves. They will buy policies externally to transfer risk. It's awesome. If you ever look at the hierarchy of what they've done, I don't remember how I got to see it, but it's fascinating. They have layer upon layer upon layer upon layer to protect themselves. But there's a reason the stocks do so well and they've done so great. And if you are not a WR Berkeley shareholder, I'll tell you guys, ever since I became one, it has not done poorly. I'm going to knock on wood as I tell you this, that. But
What's the ticker symbol?
Oops, as I said.
Regarding the class code, so
Oh, yeah.
Class code, like you said, right? It's to identify the risk for
Yes.
specific work.
Yes.
Is it at the federal level and then it can be overwritten
Yeah.
at the state level?
They are done. Class codes are produced by, I thought it was NCCI, and those are at a federal level. So that it does not matter if you are operating in the state of Iowa or the state of Idaho or Ohio, the class code would be similar. Now, programs might have, like, one number can make a huge difference if you are off on like clerical staff. I know there's like 10 codes that can fall under clerical staff. And so like a 201 code versus a 204 can be priced very differently. So a lot of times when people are asking for the data to support it, it's because it will absolutely translate over onto like a code 204 is this many cents per dollar of payroll. And that is how they assign the financials to what we're going to ask this person to pay us for their insurance.
I thought they could be, I mean, from what I heard from some of our clients, I thought they could be overwritten at the state level. That's not accurate.
I was under the impression that they are done at a federal level. States
Okay.
might have more specificity with
Oh,
it,
I
but
see.
that they are, so that it does not matter what state you're in, like a clerical staff versus an industrial staffing company are going to have different class codes that are recognized as a whole.
Mhm.
Because if you were doing it state by state, that's going to be a ridiculous amount of different operating codes. Now, where you see some of the trickiness that lies in this is people, like, being very transparent on this, like the people that human traffic, like when we start looking at environmental, or when we look at labor from that standpoint, and being in the Midwest, this is a lot more common, where we would insure farms and you've got these workers who do not have social security numbers, and to appropriately insure them, once they file a claim, whether that employer has paid for payroll for them or not, states will have you insure that person, because it's now on the employer for not having the right insurance, but that employee, there's technically a relationship there, and the state will have benefits due. Now, depending on a lot of things with that, it might only be medical benefits. They might not qualify for any type of permanency if they are severely disabled. This is where it gets a little tricky, but that stuff is so real. It's way more real than I ever thought it possible. So insurance companies will come back and then assess penalties to employers if they are lying about who is an actual employee with a social security number. Is it a real social security number? Is it fake? And what does that look like? You can get in a lot of trouble for that. So when we start looking at dollar for dollar on insurance fraud, it's much, much, much higher on the employer side than somebody coming in and faking that I hurt my shoulder over the weekend.
Okay.
It's gnarly.
thank you.
So, Claire, correct me if I'm wrong. My only experience with seasonal agricultural workers is in California, and that's like its own beast. That's
California is
it's
definitely
a
its
very
own beast.
well, no, not just so. Yeah, well, I know, I know California's its own beast. It's a beast with, yeah, it's a couple of beasts, I'd say. But even within that, just seasonal agricultural workers are just like a subdivision all in itself, and they're insured differently and things like that. Is that correct?
They would be. It depends on the company that's going to write that policy. But again, whoever's going to write the policy, it is ensuring the work that's being done. And then whether the claim is accepted as it's going to be deemed under workers' comp or not will be determined by that insurance company. So sometimes they'll say there's no employee relationship because it's out of season, or they were doing work that was outside that scope. That becomes more of a compensability question and not a who's actually providing coverage.
Got it. Okay.
So a little different. Compensability gets to be the other gnarly part of this, but these are just how people transfer risk.
Got it. Thank you.
You got it.
Okay.
All right.
Nice long awkward silence to finish it up.
Yeah, just make sure everybody.
Well, thank you so
Right.
much, Claire.
You got
Really
it. I
appreciate it.
will.
Yeah, thank you.
Make sure, Bill, I will follow up with you on, here's the states. Actually, I'll put it in your cheat sheets so that we can make that a little bit easier. And I'll get all your takeaways over to Kim. And I'll see you guys again in 2 weeks for more work comp awesomeness.
Thank
Thank you so much, Claire.
Thanks, Claire.
Thank you, guys.
Bye.
Have a good one.
Okay,
Bye.
bye-bye.